No one ever wants to hold Cisco in 2001 and it drops, 80%. We all want to avoid those things. We know in our hearts that diversification is important, but, these biases are real. And, also like a recency bias, right? So right now, NVIDIA is another great example of this. NVIDIA's done phenomenally. AI is in the news everywhere. I'm pretty sure golf drivers are considered AI now. They have AI technology. I mean, I don't know what is AI and what isn't AI anymore. So NVIDIA, the recency is AI. Get on the AI trade. But, you still have to, have a fact-based approach to combat that bias that you're going to have, that everything is AI. AI has worked for the past year. AI will continue to work forever into the future. That's not necessarily the case, and that's the reason why we diversify. I think of things, when I discuss these biases, they're really tough to overcome. But I think people, once you recognize it and just admit that, hey, I might regret this decision, I might not. No one knows what the future is going to be. No one knows if companies will actually make a ton of money off of AI, and it'll really be this transformative technology. It may be somewhere in between the extreme positivity and bullishness that we have now and bearishness. It could just be somewhere in the middle, right?
Matt, anything else like fear of missing out, or you have
and I kind of lump that fear of missing out is I say that's a better term for regret aversion. I think that people don't make decisions because they're fearful they're going to regret or they're going to miss out on the future appreciation.
When I think of a behavioral bias that a lot of us have is the endowment effect. The endowment effect is placing a higher value on things that you own just because you own it. And so you see that a lot with corporate executives who are heavily concentrated in company stock. Not only do they work for the company, but they own a heavily concentrated position. So they think it's more valuable because it's attached to them. So, and then another one is anchoring. You can anchor on a certain price, whether that's on the upside, generally on the upside. If a stock has gone up to a level, let's say it ran up to $100 a share and it drops down to 90, you're stuck. You're anchored to 100, and I can't sell it unless it gets back to that old price. And then it goes from 90 to 80, 80 to 70, 70 to 60.
Yeah, in some ways we try to, as advisors, try to coach people into, not doing anything, is, not taking all or none decisions, right? So maybe we sell a portion of the stock, we sell 25%. Maybe you just take your original investment off the table. So if I invested 50 grand and it grew to 200, maybe I just take my 50 grand off the table. Like you're on a run at the blackjack table, you've done really well, you take some chips, put them in your pocket. And we're not just saying go to cash. You're just going to rebalance those proceeds, likely take them from stocks and put them into 5 or 6 other stocks that continue to do well.
Yeah, you diversify the proceeds, and if the original position continues to go up, there's likely some correlation in how the rest of the market may be doing, or there could be a correlation between that stock and the rest of the market. So if you diversify, you're just spreading out your risk. Doesn't mean you can't continue to thrive in other positions. You're just taking some risk off the table by diversifying.
Exactly. And I think it's just that acknowledging nobody has the crystal ball, nobody has the perfect answer.
But what do you think about this concept of, you've never seen someone go broke by taking profits? So taking profits is a good thing, but I would argue that that's one of the benefits of indexing, is that the indices allow the winners to run.
Depends on the index, right? Like the different index methodologies mean different portfolios. So like S&P 500, the traditional index cap weighted, yes, absolutely. If you're going to look at the S&P 500 equal weighted, not necessarily, right?